Okay, Assalamu alaikum. Bismillah Rahman Rahim. This is the final chapter. Okay, and these slides were prepared by Mr. Guru Nasir, which is one of our visiting faculty member. Okay, I'm using the slides to convey this topic. So, what are liabilities? We all know. The loan which the company has required. Bonds payable is one of the long-term liability. Okay. Uh, Whenever a company issues loan, so let's say a company borrows 1 lakh at 12%. You can see borrows 1 lakh at 12%, and there's a tax rate of 40%. So the company has to pay interest 1 lakh into 12%, which is 12,000, but there's going to be certain tax savings. And tax saving would be the interest into the tax rate. So that is 4,800. And because of this tax saving, the after tax cost of borrowing would decrease to 7,200. Although the company will be required to pay interest charges of 12,000 to the creditor, but the government is grant them tax saving, which is 4,800. And in this case, because of this tax saving, the cost of borrowing after tax will reduce to 7,200. I hope this concept is clear. So whenever the bonds are going to be issued, okay, so let's say in this one, the Gamma Corporation issues 1 lakh 12% semi-annual coupon bonds for 10 years, okay, on March 1, 2014. So the entry would be March 1, 2014, cash debit 1 lakh, bonds payable credit 1 lakh. 6 months after this date, that is September 1, okay, March would be the first month, April, May, June, July, August. September 1 is when we will have 6 months completed. So here we'll be paying interest, okay, of 6 months. So how will that be calculated? We all know that interest is equal to principal rate into time. Here the principal is 1 lakh. The interest rate is 12% and 6 by 12, which gives us an amount of 6,000. So 6,000 interest expense debit, cash credit. Okay. So 4 months later, we'll have year end and we'll have no payments paid on this day. But since the year is going to change, so here we have to record depreciation expense for 4 months because they are 4 months ahead. So the interest expense for 4 months would be 4,000. Since it was 6,000 for 6 months, that means 1,000 per month. So 4,000 interest expense debit, 4,000 interest payable, or interest payable credit. On March 1, that is going to be after 2 months. So we need to record interest expense of 2 months, which is going to be 2,000. Interest payable, which was recorded previously, is being paid here. So interest payable is debited and cash is credited. So these entries, okay, September 1, 2015, we have the same entry repeated again. December 31st, 2015, we'll have same entry repeated here. March 1, 2016, we'll have the same entry repeated. So that means for next 10 years, these interest payment entries will remain the same. But at maturity, which is going to be March 1, 2024. So in that case, what we are going to do is, give me a minute. Okay, so in this case, we what we have is, so so here we are going to have 2024. We'll have same entry repeated. And with this, on March 1, 2024, again, we'll have reverse of the first entry. That is, bonds payable will be debited by 1 lakh and cash is going to be credited by 1 lakh. I hope that's clear now. So that is what bonds payable for and how we going to record it. The first one is easy. The second one is this payment plus interest payment. The third one is interest expense and additional interest for the interest expense. And the fourth one is interest payment, second interest payment. And this same entry will be reported repeated at maturity. And finally, at maturity, bonds payment debit and cash credit. Bonds payment topic is clear. Then we have another special liability which is called lease. It can capital, we'll be talking about capital lease. The capital lease, the asset is initially owned by the bank. So after all the payments are made, the asset is transferred to the lessor, the tenant. So here we have two parties. The owner is called lessor and the tenant is called lessee. So the entry which will be made by lessor when the asset is given on lease is these payment received will debit, sales credit, cost of goods sold debit, inventory credit. By the tenant, it would be lease equipment debit, lease payment obligation credit. Okay, the payments which is going to be made, okay, so cash is going to be credited when the payment is made by the lessee. A portion of that amount will be recorded as interest expense, and remaining portion will be recorded as lease payment obligation, as it's going to decrease the liability. In case of lessor, cash will be debited. The interest expense, which was recorded for lessee, will be interest revenue for the lessor, and lease payment receivable will be credited for the lease. So now continue with the same example. With the example here, it talks about that custom truck builder frequently uses long-term lease contract to finance the sale of his truck. On November 1, 2011, custom truck builder leased to State Van Line a truck carried in the professional inventory record at 33,520. The term of the lease called for interstate van line to pay 36 monthly installment of 1,400 each, and this will begin from November 1, 10, sorry, November 30, 2011. The present value of these payments after considering an equal interest of 1% per month, since the interest rate is 1% per month, so the annual interest rate would be 12%. So the amount is equal to 42,150, the sales price of the truck. And at the end of 36 monthly, the title of the truck will be transferred to Interstate 19. So what we have to do in part A here, we have to prepare entries for custom truck builder for number one, that is to record sales, finance by lease, and related cost of goods sold. And the second entry would be on November 30th, where it received the first as installment, and then December 31st, where it received the second monthly installment. We can see the entry recorded by custom truck builder. Lease payment receivable debit 42,000, 42,150. Sales credit 42,150. Cost of goods sold debit 33,520. Inventory debit 33,520. I hope that is clear. Okay. And the first installment payment will be on the 30th of November. Cash debit by 1,400. And here we need to understand the committee calculation, how interest revenue is calculated. Since the loan amount is 42,150, so 42,150 into 1%, which gives us 42,000, 4,000, sorry, 422. So 1,400 minus 44,422 gives us 978. So this 978 represents that the lease payment receivable has been paid off. Now, what will happen? The amount of loan would not be 42,150. We are going to minus 978. So this amount is going to reduce. So now we will calculate 1% on the reduced amount. So the interest comes out to be 4,112. Since there is going to be equal amount paid as installment, so the lease payment receivable would increase by 10, and it is going to be 988 as compared to what it was 978 in the last in the first payment. The entries which is going to be recorded by the lessee, these equipment will be debited. Okay. For 42,150, these paid obligation is credited by 42,150. Now, cash is going to be paid, so cash is credited. The interest revenue which was recorded in the previous slide, okay, will be now recorded on expense. Lease payment receivable which was credited will be now recorded as lease payment obligation for this exam for the next. And similarly, the second installment. I hope these answer all of you. Thank you very much. If you have any question, you can post it on the group and we can address it. Thank you very much.